Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG. I thought we'd come to you today with a brief market update, kind of let you know what's going on out there. S&P 500's just a shade below 4,300 as we speak. Having given up quite a lot during the month of September. We were down about 5% during the month of September. Still up about 12% for the full year, which is a pretty good year in anybody's book, but obviously a little disappointing to see the price action in September. And the sort of yin and yang of interest rates and equity markets that we saw that was really the story for most of 2022 really came to the forefront again in September of 23. Because while we saw that equity market drop about 5%, we saw yields on the 10-year Treasury climb from about 4.25% all the way up to about 4.65% as of this morning, which is pretty high. I mean, that's certainly higher than they've been throughout the entirety of the cycle. And what's really going on is this whole narrative of the soft landing or an ability to fix inflation without necessarily having a lot of economic weakness on the other side of it is really starting to take hold. We saw from the Fed minutes that they have, and from their dot plots, from their economic forecasts, that they are sort of predicting that that is the path that we are going to go down. We've seen a number of the Wall Street banks get on board with the party bus of, hey, maybe we aren't going to have a recession. And the interesting thing about that is you need to remember that the Fed has a dual mandate, right? The Fed has a mandate to raise interest rates when inflation is high and try and combat inflation. And then it also has a mandate to lower interest rates when unemployment gets very high and try and get people back to work. We refer to the Fed's dual mandate as inflation and unemployment. Unemployment doesn't really seem to be a problem right now. It's at around 3.5%. Certainly, the labor market continues to just run along a pace, if anything, might be very, very hot. And so long as that's the case, there's really not any real impetus for the Fed to lower rates. Which as people start to work into their forecasts, they start to think, okay, well, maybe the Fed funds is going to be at 5.5 for longer than we thought. Fed doesn't really have to lower interest rates anytime soon, and so that brings the 10-year Treasury up, and that increase in the 10-year Treasury rate impacts valuations for stocks, and so we start to see those stocks decline a little bit. So interesting to see that narrative reemerge. Unclear how much legs it really has going forward, if we'll see October or November continue in that vein. I would just say, the Fed has indicated that 5.5%, which is where we are on Fed funds, is pretty close to the top of where they think we need to be. And with the 10-year Treasury closing in on 4.6, then you really have to have some pretty rosy economic forecasts for how long we're going to stay at 5.5 before the Fed starts to move to a more accommodative stance for that math to kind of average out. So it feels like we're getting closer to the top than the bottom, just based on where interest rates are today. I would also be remiss if I did not point out that we narrowly averted a government shutdown last week. We have kicked the can down the road successfully for 45 days. And in the meantime, the House is getting ready to try and oust the Speaker of the House, which is something that will create some eyes on Washington over the next 45 days. I don't think that the market's really going to rally much on the back of kicking the can down the road for 45 days. The market tends to be very, very forward-looking, and it understands that we're just going to have this same fight again, about 6 weeks from now. So don't expect to see the market react too terribly positively to that. As always, if you have any questions, please feel free to reach out to either myself or to your advisor. Hope you're having a great day, and I look forward to talking to you again soon.